This is the second webinar that I'm involved with at MILE. Can you hear me, Ali?
Yes, sir. We can hear you loud and clear.
Wonderful. Unfortunately, I won't be able to be with you for 1 hour. I need to catch a flight later on. But I'll try to be as brief as possible. Ali, again, thank you for the introduction. The last webinar I was involved with was actually on strategic foresight and decision-making within the context of uncertainty. Now, I would define strategy as allocating resources with the objective in order to maximize shareholder value. And this is, in essence, the definition that can apply to any size company, whether this is a company that is owned by, let's say, a family, or whether that's one that's publicly traded, but also would apply to conventional finance and to Islamic finance alike. And we will talk about that a little bit more during this webinar. Let me start with the role of the financial manager. The role of the financial manager, and more specifically the chief financial officer, which I would categorize as the corporate architect. And an architect, if the person properly designs a building, then the building is going to last for a long time. The same applies actually to a chief financial officer. If the way that the financial policy of a company is designed will, to a large extent, reflect how long and how well the institution is going to last and be successful. So the chief financial officer has a very, very important role to play in a company as its corporate architect. And within it, we really have two functions. On the right hand, we have the controller, and the controller is responsible for, in essence, the required legal statements. And in some countries, there may be no corporate taxes. In other countries, there are, and if that is the case, then also there is going to be a requirements for the tax filing. But in essence, this is in order to prepare the income statement, the balance sheet, and to make sure that these statements are properly reported, but also audited. So as a result, an auditing firm will be involved as well in doing so. On the left-hand side, and I'm typically a little bit more excited about the role of the corporate treasurer, is that the finance function is also responsible for cash management, but also raising capital and the relationships with financial institutions. A controller will very often hold a CPA, will be a public accountant, and will have a certification. In terms of the treasury, you also have increasingly certifications available, and for example, the ACT in Britain is providing a certification as such. Now, in terms of who eventually becomes the chief financial officer, that very often depends on the company. Very often it's actually through the accounting or controller role, but that doesn't mean that it couldn't be through the treasury role. Now, looking at the function of financial markets, because the function of financial markets is also going to be very important. And of course, this applies to a company then that is publicly traded, not, for example, a family business, where actually it's the family who would actually provide the sources of funding. But the financial markets are also very important for publicly traded companies. Economists would say the market knows, and that is something that I would typically also acknowledge. The market knows because the market has, as a collection, not a single individual, but as a collection, they actually know how certain businesses how certain drivers of a business develop. And of course, they provide an important source of funding, but also they provide an important way to manage risk. Very often it's reflected through beta, and beta is in essence the relationship or the covariance between the volatility of the stock price of a particular company and the volatility of the market as a whole. And the lower that beta is, actually the better it is. So if a company actually constructs its portfolio of activities well, it will tend to have a low beta. So the financial markets actually allow for sources of information, sources of funding, but also liquidity and a way to actually manage risk. Now, how is that done? In essence, it's done, on the one hand, cash is raised from investors, and that's of course at the center you have the financial manager. And the financial manager will be responsible for making sure that that investment is made in the firm operations. Let's say a manufacturing or an assembly facility for smartphones. Now, that assembly facility needs to or will return cash generated from operations. And that's returned back to, or is brought at the disposal of the financial manager. And then the financial manager again has to decide what to do with it. A company is typically a going concern, so as a result, the financial manager will tend to reinvest a particular share that's reflected in 4A in the business to make sure that the going concern and actually the business can grow, but also some part of that is actually returned to the investor. Now, this is not fundamentally different between traditional finance and Islamic finance. We'll come back to that in a minute. But let's now turn to Islamic finance. And if we look at the global Muslim population, it's a very large population. It's about a quarter of the global population. And although it's strongly concentrated in the Middle East, North Africa, and certain parts of Asia Pacific, it's basically globally. There's almost no country in the world where you wouldn't find some share of Muslim population. And Islamic finance is a growing group of financial products. We will look at what these financial products are. And they are really developed to meet the needs of businesses established by Muslim populations. So, and as I said, it's a very large group. I put here between 1.5 and 1.8 billion, depending on the source, but it is a very large group of people. Now, if we look at how it has developed over time, it's actually quite fascinating. Of course, it existed in principle before the 1970s, but in the 1970s, we started to actually see commercial banking. And each decade almost, there were some additional products added to the portfolio of the broader spectrum of Islamic financing. So project finance, which is also very often referred to as limited or non-recourse financing, was added in the 80s. In the 90s, equity financing, but also Ijara. And then in 2000, we see structured alternative assets, but also the emergence of the sukuk, or what is also called the Islamic bond. I now work in Kazakhstan, in the Kazakhstan Development Bank. We recently raised a Malaysian sukuk, for example, an Islamic bond, in order to focus on infrastructure, but also manufacturing asset investments in Kazakhstan to help the development. The sukuk is becoming extremely popular as an Islamic bond, and it has become a very competitive instrument within Islamic financing. And then starting 2007, 2008, we saw some additional instruments, liquidity management tools, but also Islamic insurance, like the takaful, which is mentioned on this slide. So if you look at it, it's actually a very broad portfolio of tools, instruments that can be used within the context of Islamic finance. Now, I really want to turn about what Islamic finance is, and I won't go through this slide in detail because actually I have 5 examples of typical Islamic finance transactions that will explain this in more detail. But the fundamental principle is the function of money in Islamic finance. Islamic finance does not deal with money directly because money cannot earn more money by itself. That is actually a very core principle that you see in Islamic finance, but you don't necessarily see in conventional finance. Actually, in conventional finance, as we see later, actually money can make money by itself. Not so in Islamic finance. That's one of the key differences, in my view, in between Islamic finance and conventional finance. What does it mean? As a result, money must be put into a real business activity. And me as a strategy finance professional, I see a lot of value in this because we need to make productive assets. And when we make productive assets, we can actually create value to societies. And given that, it makes a lot of sense actually for money to be invested in real business activity as opposed to just putting it into a bank and trying to earn interest, which doesn't work in Islamic finance. Now let's contrast this a little bit and we're going to look at bank relationships. First, suppliers of funds, and then we also going to look at the user of funds. And these 2 examples actually come from CIMA Global. Most of you may know CIMA. It's a British, but of course a global company or institution that actually provides mainly accounting qualifications. But it also has an Islamic finance qualification, which I would recommend as a professional qualification. Now, when we look at conventional banking, we have typically, when we look at suppliers of funds, we have the lender-borrower relationship, and it's interest-bearing. So it could be that there's a supplier of fund, let's say $1 million, that's being borrowed, and that is put into, let's say, again, the manufacturer of mobile phone or the assembly of mobile phones, but in order to borrow that money is going to be interest-bearing. If you look at Islamic finance, that cannot be the case. We will get back to that. This is the principle of riba. And when we look at the lender-borrower relationship, it does exist, but it has to be interest-free. That's one way in Islamic banking. Another way to actually have the relationship with suppliers of fund is the depositor custodian, the investor entrepreneur, but also between partners in a business venture. So there's a variety of ways that actually there can be a relationship in terms of supplier of funds, but the key principle is if it's lender-borrower, which can be in Islamic finance, it has to be interest-free. Now turning to user of funds, again in conventional finance we have borrower-lender, again it's interest-bearing. If we look at Islamic finance, it's fundamentally different. It's purchaser-seller, lessee-lessor, in the case of, let's say, a lease agreement, principal-agent, and again what we've seen in supplier of funds, the same applies for user of funds, is between partners in the business. And when we look at partners in the business and some of the other examples here, we'll get back to it when we look at specific transactions. But before we do that, let's look at the prohibitions within the context of Islamic finance. The first one, and which is, in my view, the key difference between Islamic and conventional finance, is a riba. And there are 2 separate classes of assets, currency and selected commodities. And when we talk about selected commodity, it's really a small group. The example that's very often used is a food item, are subject to riba. What does it mean? Riba implies that any interest on these asset classes is prohibited. That means not allowed. Not allowed at all. So there's no tolerance at all within Islamic finance for it. Now, what does that mean? Let's have a look at an example. Let's first look at a currency transaction. And then afterwards, we look at a food transaction. Now, the first is the same currency, euro for euro, let's say. Sharia requirements would say it needs to be a spot transaction and an equal amount. So it could be that there is a transaction, let's say, with the kingdom, and that someone needs somewhere in another location euros, let's say, in somewhere in Europe. Well, it has to be a spot transaction and it has to be an equal amount. That basically means, according to Riba, you cannot make a profit just from a transaction from euro to euro or from a currency to a currency. Different currencies, it's the same principle that applies. Let's say US dollars for euro. It's a spot transaction on the prevailing exchange rate. It has to be spot. It cannot be deferred. It has to be spot. Very, very important. Commodity, food specifically, it's not all commodities. Why food? Because food actually is a usury product. So let's look at same food. Let's say wheat for wheat. And also let's assume it's the same quality, but also let's say at a different location because let's say it's traded somewhere. Again, it has to be spot transaction and equal amount. This is the same as same currency, euro for euro, but here it's a type of commodity which is food. Now let's turn to when it's a different type of food, let's say sugar for wheat. It has to be a spot transaction, but again based on an implied exchange rate. It may not be, both of them are traded, so as a result we know the value given a certain weight, let's say a kilogram or a ton, depending on the size of the transaction, and it has to be again based on the spot transaction. Some very fundamental principle here of riba, which is basically you cannot make or pocket a profit based on two separate asset classes, which is currencies and food. This is prohibited in Islamic finance. Now, let's turn to Gharar. And I may not pronounce this 100% perfectly. I've received comments from people in the region of this. Sorry about that. But Gharar prohibits any transaction that involves extreme uncertainty, gambling, and risk. Gharar tries to avoid making any transaction that could lead to a detrimental outcome to any party because of a lack of knowledge or risk. Well, riba in conventional finance, one can debate. In Islamic finance, we cannot debate. But Gharar, in my view, makes sense in both Islamic finance and conventional finance. So in conventional finance, in any kind of transaction I've been involved with, it also, even if it was using conventional finance, it adhered to the principle of Gharar. We're not in the business of gambling. Gambling, you leave that over to other people. Also, I'm not a gambler myself, and also I've never been involved in the funding of a gamble business. And actually, a strategist and also a corporate finance person, in essence, needs to understand risk and uncertainty. And by understanding risk and uncertainty, can actually make an informed decision. So gambling, obviously, is a totally different aspect, but it's also a very sound principle about understanding the underlying risk and uncertainties. So Gharar prohibits very clearly investing or transaction that involve extreme uncertainty, gambling, and risk. And for me, it's totally intuitive that this is a very sound practice. Let's turn to Gharam. And Gharam is one of the other aspects that I found as a very sound business practice. Haram implies that only Sharia-approved investments are allowed. What does that mean? One cannot invest in things that are considered unethical. Casinos, again, comes back to gambling activity, tobacco, alcohol, sex-related activities like pornography, like prostitution, are actually totally prohibited. Again, when we say totally, it's 100%. There's no tolerance here. Again, I've never been involved in any transactions that included any of these, even in conventional finance. So when I look at these three, Riba, Gharar, and Haraam, although I've been involved under conventional finance, in interest-bearing investments, I've never been involved in any type of investments that actually violated the principles of Harar and Haraam. So if you look at the difference between them, at least from a sound business principle, it's only really Riba that makes the big difference. So let's kind of sum this up, not necessarily the prohibitions, but look at the silent features of Islamic finance. And here are about 6. If you look at various sources, books, and maybe other presentations, they may arrive at 7 or 8, but I try to put them together in a succinct set. One we discussed already quite extensively, interest-free. It's the principle of Riba. Number 2, based on the principle of risk sharing. We will later look at this when we look at the various types of transactions. The principle of risk sharing, again, makes a lot of sense to me. If you share risk, there is a much bigger chance of actually having a venture or a business venture that endures over time. The need for an underlying asset, which is also very important. Again, there's some relationship with the fact that money cannot make money in itself, and as a result one needs to have an underlying asset that at least the title is owned for a certain period of time. Free from unlawful goods and services, we discussed that before. That's the principle of Haram. If you look at 5, free from gambling and uncertainty avoiding, principle of Gharar. Uncertainty avoiding, one cannot fully avoid it, but understanding it allows to have insights and make an informed decision. That is clear. Gambling, obviously, fully prohibited. And of course, it has to be, in general, Sharia compliant. So these 6, in my view, are the key silent features of Islamic finance. Let's turn to some of these transactions. I have 5. There are more transactions. And in June, when I will have the course both in Jeddah but also in Medina, we will look at other transactions, but also we're going to apply them specifically to a pretty complex and comprehensive case that actually plays out in Kuwait. So 5 types of contracts we're going to look at. We're first going to look at the cost plus. The cost plus is also called the Murabaha, and we have several parties involved. We have a supplier, we have a customer, we have a financier. What is the cost plus? Well, in essence, it is a fixed income loan for the purchase of a real asset with a profit margin instead of a fixed rate of interest. The cost plus is the fundamental difference that actually allows the Murabaha to meet the Riba requirement of Islamic finance. And because the financier, which is in the middle here, has actually owned, it may be for a very short period of time, the asset, the profit generation or the markup or the cost plus is in essence not interest, and as a result fully compliant with Islamic finance. So this is a cost plus type of contract, and the key reason why it is accepted is because the supplier actually transfer the title of the asset to the financier before it's moved on to the customer. This is transaction or type of contract number one, cost plus. Number two is a partnership contract where the funder has executive involvement. This is called Musharakah, and what you see here, you have two partners, partner one and partner two. It's in essence a form of venture capital, and it means sharing. It's also the purest form of Islamic finance. Remember, and let me go back a few slides, what we have in the middle here, number two, based on the principle of risk sharing. I'll go back to the slide. This is at the core of Musharakah. It's based on profit and loss sharing, or the principle of risk sharing. What could be the case is that the nature of the input of the partners, partner one and partner two, is different. In this case, what I put down here, the input from partner one, let's say, is cash. But the input of partner two is physical capital. This could be land, this could be a productive asset, this could be a plant. So basically, they both bring in something, and it's valued to be a certain share in the partnership. It doesn't have to be an equal share, but it has to be understood what the share is and what the value of the share is. Profit sharing terms are agreed in advance, and this is also very important, in advance, so that basically there's no disagreement possible afterwards. And losses also are fixed to the amount investment. So it cannot exceed the amount of cash as provided by partner one, nor can it exceed the physical capital as provided by partner two. So in essence, it is a limited liability party or partnership limited to what has been brought in by the various partners involved. Again, I would like to phrase here, this is one of the purest forms of Islamic finance because it's based on a true partnership that's equitable and where the risks and returns are well understood from the beginning, and as a result there's a very good chance that this partnership can actually or the J venture project in this case can endure over time and be successful. Let's turn now to something completely different, and increasingly I hope that we see the diversity of the types of contracts that Islamic finance is providing. So we looked at two examples already. One is the cost plus, the other one has to do with a partnership. But in this case, let's look at construction finance. It's called Istina, and typically it is for something which is substantial in size. Let's say this is for the manufacturing of a LNG tanker. LNG, liquefied natural gas. In the Gulf region, Qatar is a major exporter of natural gas, and it needs LNG tankers. Well, if you need an LNG tanker, these are very large ships, very expensive ships as well. So what would happen here is that the customer would order the LNG tanker, but it orders it to the financier. The financier will then commission the goods to a manufacturer. Let's say a shipbuilder in South Korea. Now that shipbuilder wants to be paid for it, but that shipbuilder is going to bring a particular expertise and will then manufacture the LNG tanker made based on the requirements as communicated by the financier, but in essence based on the requirements from the customer. So the manufactured goods are going to the financier, and then the financier will hold the title, and the financier will then transfer the title to the customer, for which it will actually receive a sales price. Of course, the financier is going to make a profit on it, but that profit is again compliant with riba for the very simple principle that the financier will acquire the title to the asset as leased for a short period of time. Now, why is this important? Well, it's important because the customer may actually not have the funds available in order to finance a very large asset, in this case an LNG tanker, but also at the same time to build a tanker like this requires specific manufacturing expertise, and the customer itself may not necessarily hold this. So this is construction finance. It could even be that this takes more than a calendar year to manufacture. Some of these structures take multiple years to make. Ships are not the only example. It could be a large industrial project, let's say a refinery that's going to be built in the kingdom, or it could also be a different type of major construction asset, for example, a road, a bridge, something that is substantial in size and for which Istina finance could be used. Another example to illustrate again the diversity is Ijara. And Ijara is an operating lease. And what is it? It's in essence the sale of the right to use and benefit from an asset for a specified period of time in return for a specified consideration. You also see on the left-hand side, you see the orange lines. And this is a particular aspect of Ijara, is that it can be constructed to include the sale of the asset, typically on maturity, to the lessee. So basically, there is an operating lease, but what happens is that on maturity, the title of the asset transferred to the lessee. So the lessee becomes the owner of the asset. Again, there's no interest charged here, and it complies fully with riba because the financier actually owns the assets, thus bearing the risk of the ownership. The profit generated on the lease is regarded as a profit from the asset, so not interest. So again, riba, Sharia compliant. An operating lease, again, adds to the diversity of the portfolio available in types of contracts of Islamic finance. The last example I want to use is called Mudarabah. It's a profit-sharing contract. And what we have here is the Mudarabah is the following. You have on the one hand, there is a capital provider. Then there is an investment manager. The investment manager is often called Mudarib. What does it entails? It's a profit-sharing contract where the capital provider provides the capital to the investment manager. The investment manager or the Mudarib provides expertise, so basically can make good investments, let's say in a business venture, and with the objective, of course, to return a profit. The profits generated by the business venture are shared between the parties, which is logical because it's a profit-sharing contract. But they both bring in very fundamental different expertise. One is an example of a capital provider, the other one provides expertise. Not to be confused with what we saw before, because in the previous example, there was one that provided capital, but the other one provided an other physical asset. In this case, the investment manager is not providing a physical asset. The investment manager is providing a valued expertise. If you look at then the risks and returns, the capital provider bears all the possible financial losses because of the nature of the input, the capital, while the Mudarib, on the other hand, bears the opportunity cost associated with managing the venture. And of course, the reputation that goes with it. A successful business venture will be very good for the Mudarib, where actually an unsuccessful one would be not very good for the investment manager reputation of the Mudarib. This type of profit-sharing contract is very often used in investment funds, but also in project financing. We saw before, when we looked at the trends of Islamic financing, there is limited recourse or non-recourse financing, which is project financing, and this type of contract is very often used in that context. Well, that said, this is the end of my presentation, but I wanted to say a few more things in closing. If we look at the real difference between Islamic financing and conventional financing, the real difference in sound business practice is riba. Sound business practice in conventional financing also, at least based on my experience, complies with Gharar and with Haraam. It basically means let's not invest in anything that is unethical and in anything that is bearing a risk that nobody should in essence bear. But riba is the fundamental difference. Looking then at the portfolio of instruments, and I go back to the development of the Islamic finance market, which is over here, there's really a very broad portfolio that really of instruments available that tailor to the needs of a community, and virtually anything can be structured and financed as long as it meets the requirements of riba, haram, and hari. Thank you very much.
Well, thank you very much, Professor. I understand that we are running short of time as you have to leave earlier, so we are going to make a quick Q&A section. Folks, if you have any question, you could raise your hand and I'll be able to give you an opportunity to speak to Dr. Alexander, or you could put your questions in the chat box. I see there are a few hands already raised, so let me just quickly move over. We have a question from Brother Sayyid Ali. Can you hear us?
Yes, I can hear you.
Yeah, could you please introduce yourself and then ask the question, please? And please be precise and short.
My name is Sayyid Ali. I am the finance manager in Saudi German Hospital Group in Yemen. My question is, how is Mudarabah Murabaha future profits from assets is estimated? And if we use discount rate, then would it be the Islamic financing or it will be the normal financing?
So if I understand your question well, you're talking about the cost plus structure?
Yes, I'm talking about this.
Okay. Well, in conventional financing, the cost of capital is going to be based on the way that a project is financed. And a project is financed typically by by debt and equity. So there's a cost of equity in there, there's a cost of debt in there. The cost of debt, typically it's the after interest cost of debt and the cost of equity. And that is then used for discounting purposes. This is conventional financing. In Murabaha, the cost plus, one can say, well, in essence, is it not the same as in Islamic financing? Well, there's a fundamental principle in finance, whether this is conventional financing or Islamic financing, that there's a relationship between risk and return. In Murabaha, it's fully compliant with Riba, because the financier actually holds on to the title of the asset. It may be short, but as a result takes on the risk. Now, the way that the cost plus, okay, basically the return to the financier is calculated, is going to be different than in conventional finance. It's not going to be based on the same way, but it's based on an equitable appreciation of the relationship between risk and return. And that is going to be a negotiation, in essence, with the financier, depending on the underlying risk of the asset. You mentioned that you are in a hospital.
Yes.
In a hospital which is a social and public service, one could argue that, depending of course on the country and where the source of funding is coming from, that the underlying risk will in most cases be much smaller than, let's say, an asset that would have to stand its test in the market. So the underlying risk for that type of investment, and in this case also the return to the financier, the cost plus, would probably be lower than, let's say, you invest in, to use the same example as before, in an assembly plant for the assembly of smartphones. So it's based on the principle of risk and return. The lower the underlying risk, the lower the return is going to be. The fundamental difference between Islamic conventional finance is that it's compliant with Riba, and that means that the financier holds on to the asset at least for a short period of time.
Clear.
Okay, well,
thank you.
Thank you. Thank you very much, Brad. Sorry. Sir,
no, please do.
Okay, so let's move to the next person. Let me try to unmute. Brother Samir Al-Munif, can you hear us?
Yes, hi, how are you?
I'm fine, sir. Could you please introduce yourself, where you're calling from, and please...
Yes, it is Samir Al-Munif. I'm from Riyadh, actually, based in Riyadh.
Okay.
Hello?
Hello, yes, sir, we can hear you. Could you please ask the question?
Yes. Hi, Mr. Hi, Alexander. You know, it's good to hear you again. You know, I attend a session in Riyadh with you. It was about scenario analysis. It was great workshop. My question is about the wakala, their term in Islamic finance that you didn't touch, called wakala. We use it popularly in insurance industry. Just my question: is there any similarity between wakala and Murabaha, and if there any difference between wakala and Murabaha? Could you explain more? Because it's very popular term, especially in my industry, in insurance. Thank you very much.
I have to say that insurance is unfortunately not my strength. I've always been involved in investment in real assets, very often for large multinational organizations. I would be very happy to talk to some of my colleagues and actually let you know about this. I understand your question, but unfortunately insurance is not my strength. Well, just for your information, I'm an investment professional and an academic. So basically, I analyze the investments of projects, very often in oil and gas sector, but not only in oil and gas sector, but very often very large investments that could be global in nature. But about insurance, unfortunately, I have to say that it's not my forte.
Okay, thank you very much.
Okay, thank you very much, Brother Tariq.
But if I may ask the following, what I'll do, I'll send an email to Ali, and Ali, if you would be so kind to pass it on to this individual, but I will look into it and to make sure that I provide you with a proper reply.
Sure, sir.
Yeah, good. Thank you very much. Thank you
very much, Brother Samir, and I'll certainly follow up with the professor on your question. And let me move to another questioner. In fact, there have been questions in the chat box as well. So let me see. Yes, we have a question from Mr. Sobi Bhatterjee, who said, if the CFO takes over 3 functions of his own than that of the treasurer, does this cause any risk to the organization? I think it's one of the initial slides about the roles.
The role of the CFO, yes.
Yeah.
So if the CFO takes on, say again?
Takes over 3 functions of his own than that of the treasurer, does this cause any risk to the organization?
Well, the role of the CFO is a very important role. There's no doubt about it. My view is that it does not necessarily take an increased risk for the organization. And this, of course, has to do with governance. And also that the CFO will make sure that he or she has the right people doing the right type of task. The role of a controller is fundamentally different than the role of a treasurer. And as a result, the qualifications, but also the experience of a controller is going to be fundamentally different than a corporate treasurer. The financial officer very often works together directly with the vice president strategy. So it's not necessarily the CFO that comes up with the strategic initiatives going forward, but the CFO will have to make the investment decision and also the financing decision that actually maximizes the value. But then it still goes to a committee that actually is going to evaluate this in order to have the cheapest cost of funding, but also, and as a result, maximizing the value and managing the risk. What we also see very often in large companies, that you find 2 people that are on the non-executive board, that are executives in a company. First of all, it is the CEO, but also very often the CFO. And that means that there is a very frequent and strong interaction between the CFO and with the non-executives. And the non-executives, their role in essence is to ask smart questions to the CFO in order to make sure that the risk of a corporation is properly managed across geographies, across businesses, and that it's properly financed using appropriate instruments. So if properly structured and with proper governance, the risk should be properly managed. But of course, there's always a risk when we enter into a business venture. But the instruments and the tools are available, and in principle, a good CFO has them at his disposal.
Okay, and the brother has a supplementary question from Brother Bachachi. It seems Islamic finance is surely safer than the conventional finance or standard finance. So why not all the banks go for this? This will surely secure the money being lent.
Okay, well, there's very limited empirical work done in this regard to demonstrate that Islamic finance is safer than conventional finance. In order to be able to do real empirical work, ideally, one should have identical type of investments that one can really compare. One can compare apples with apples. I understand the nature of the question, and in all fairness, as I mentioned before, I really see the principles, the sound principles of the prohibition of riba, gharar, and haram. Especially gharar and haram should be used, and I say should be, I'm not saying are always used, but should be used in conventional finance and Islamic finance alike. There's really no reason in order to do gambling. Gambling is not sound strategy. Also, why go into an ethical investments? The principle of riba can be debated. Whether that is something that in conventional finance should also not be used. Again, I understand the logic. For me, it also makes a lot of sense. I've always worked in companies. For example, I worked at Shell, and Shell will invest its money into productive assets. The idea is actually not to put it into the bank and let it make interest. A productive asset does not create value to society. So I really understand the question. There's limited empirical evidence to support that, but that doesn't mean that the underlying principles of Islamic finance indeed can basically be applied anywhere in the world. The answer is yes to that, in my view.
Okay, thank you very much. Sir, we have a couple of more questions, so I'm going to perhaps...
Ali, I will have to go, unfortunately.
So what I'm going to do, I'm going to share your email with the attendees so they can directly perhaps write to you as well, or they can pass it on to us, and we will try to coordinate with you for their answers.
Wonderful.
But thank you very much for your time and for sharing this valuable information. I would like to thank you, especially on my behalf, for giving us time to conduct this live webinar with our audience. And all of those who attended this webinar, once again, thank you very much. We will be sharing the soft copy of the presentation and the recorded version of the webinar with you all. In fact, let me just quickly show you for you if you would like to download the presentation. If you are seeing my screen right now, let me just stream it all, the link from where you can download the complete presentation. This is available on our community right now, and we will be uploading the recorded version in the next couple of days, and we will be uploading it on the same mild community. So please stay tuned, and once again, thank you, Dr. Alexander, and thank you all of you who attended. I am